So let's talk the Mooch metric, the Mooch Housing Market Metric. Anthony Scaramucci a few weeks ago put out a really nice piece where he priced his parents' home in terms of gold. It's an interesting way to start and an interesting way to think about looking at pricing in the current environment where the stock market, gold, Bitcoin, they're all at highs. Interest rates are coming down, all sorts of uncertainty globally. So we're going to look at the Mooch Market Index and talk about housing here in Los Angeles. The big picture is the Fed has cut rates once. Gold is at an all-time high, which is really significant. Well, a couple of weeks back, I saw something by Anthony Scaramucci. Remember the Mooch? Well, this guy was in the White House for a couple of weeks, blew out. Well, he really is a money guy, a hedge fund manager. And I saw a really interesting piece he put together. It's out all over social media. I'll link to it down below. But it's pricing his parents' home in Long Island in the 1962 price versus gold and today versus gold. And he uses it to demonstrate what happens with inflation and the devaluation of the dollar. And it's a very good lesson. We'll get to specifics in a bit. But it got me thinking, I want to do the same thing here in Los Angeles. So I chose to use my boyhood home, my parents' home in Hancock Park. We'll start there and run through it. The metric, and I'm going to call this gold to housing price, the Mooch Housing Market Metric. And that's how we'll refer to it, the Mooch metric. So my parents bought their home in late 1971, early 1972. We were taken off the gold standard. So what was $35 an ounce could now float freely. So when my parents bought the home, for rough numbers, we're going to say gold was at $40 an ounce. They paid $48,000 for the home. Today, it's approximately $2.5 million, and gold is at $4,000 an ounce. So here's where we'll start the analysis. I want to define exactly where Hancock Park is for those that may not be as familiar with it. But as you look at the map, your west side boundary would essentially be La Brea, the east side would be Rossmore, the north, Beverly Boulevard, and the south, let's call it 6th Street. Now, the heart would be adjacent to the Wilshire Country Club, right, between 3rd and Beverly. You'll also see the Marlboro School, the high school, and John Burroughs Junior High to the south, the public school. So our home, which is roughly 2,300 square feet, was just off Highland and in the 1st and 2nd Street area, which is walking distance from the golf course. We were the low rent piece of Hancock Park, but still, in the school district there and walking distance to the country club. I also forgot to mention to the east, you've got Larchmont Boulevard, which would be the shopping district. All right, so the home they paid $40,000 for is worth $2.5 million today. It was $40 in gold, actually a little less, but $38 per ounce of gold versus $4,000 per ounce of gold today. So mathematically, what does that work out to? Let's stop and do the numbers. So here's the math of the home in Hancock Park. So in 1971, they paid $42,000. Gold was about $38 an ounce. So they paid 1,105 ounces of gold for the home. Today, it's $2.5 million. And gold, we're going to say it's $4,000, although it's a touch higher. So $2.5 million at $4,000 an ounce is 625 ounces. So 1,105 in 1971, 625 today. Over that period, in terms of gold, you've actually lost 43%. The way to think about this is the purchasing power of money. A dollar, listen to this, a dollar in 1971 has lost over 95% of its purchasing power. Or put another way, it would take $6.40 today to buy what $1 did in 1971. Now, it's not a direct comparison, but just understand that losing your purchasing power harms people, particularly those on fixed incomes who haven't earned returns on their money sufficient to make up for that. Again, it's just a metric, but you need to think about the purchasing power. And when tying things to gold, it's not something that we've thought about a lot in this generation, but with all the uncertainty around the world, with inflation that we experienced over the last 5 years that may or may not come back again because of tariffs, we've got to try to price things in a way that we can call apples to apples and oranges to oranges. when I spoke of our home, and as I mentioned, we were on the wrong side of the tracks in Hancock Park. So that $2.5 million, 2,300 square foot home is one of the smaller homes in the neighborhood. And let me give you some of the demographics. So it's roughly 12,000 persons. The median age is 44 years old. Call it 4,500 households. The median listing price currently is $4.25 million. By comparison, a property recently sold in the neighborhood for $15.5 million. It was a 10,000 square foot home. That's kind of the range. 2.5 to 15 or 20. It's a community of 4,800 households, 12,000 persons. Average age is, 45 years old. Educational background is roughly half have a bachelor or a bachelor and a graduate degree. So it's high income, highly educated neighborhood in the center of the city. The Marlboro School that I mentioned is the private girls' school, high school, one of the best in the country. 3rd Street Elementary in the center, Larchmont, the shopping area to the east. The average household income is about $120,000, and the range, I presume, the median's $81,000, but the range is significantly higher to the upside. So I hope that helps a little bit. Let me give you just a little bit more. As of today, there are 20 homes on the market with a median listing of $4.6 million. And in that range we talked about, roughly $2.5 million to $17 million. The neighborhood is within minutes of Melrose and West Hollywood. You would also be about 20 minutes from downtown Los Angeles. If you go to the north, up into Hollywood, it's probably about the same, 15, 20 minutes. And it puts you about 10, 12 miles from the beach to the west. It's one of the oldest neighborhoods in Los Angeles. If Angelino Heights is the first neighborhood, this one is not that far behind. If you look at the classic kind of 1920s and 30s Hollywood mansions, that's Hancock Park and up into the hills. It's that type of neighborhood, very similar to Pasadena. It was the core area with the larger homes surrounded by the Melrose communities and the West Hollywood smaller homes. To the south, you've got Rimpaw and the other areas, but all very much of that same flavor, 1920s, 1930s, craftsman, Spanish styling, tile roof, that sort of thing. So the economics of real estate and why we're thinking about things in terms of gold, it really has a lot to do with the changing marketplace. And as we've talked about with gold, the stock market, Bitcoin, all of these elements running to all-time high and interest rates coming down just a touch, but coming down more, you've got to stop and ask yourself, are we at the beginning or closer to the end of the cycle? It's tough to tell. I'd argue we're past the middle, we're closer to the end of the cycle, but things can go on for much longer than we expect and prices can go much higher than we expect. But it is important to start putting metrics in place. If we head towards recession or unemployment picks up or any of the typical things that tip the market negatively, we've really got to take a look at what's happened. Because if you take the housing stock across Los Angeles, and again, my region defined as from downtown LA to the water's edge in Santa Monica, north to the Hollywood sign, and south to Playa del Rey or the airport. So in that space, you do have a range of properties, but they tend to be, for the most part, above starter home, although there's some of that. So if the economy turns south, if the writer's strike sort of thing comes up again, or AI overtakes the industry and jobs are wiped out, and all these things could happen. Maybe they'll be replaced by other jobs, maybe not. But we want to think about pricing. And the reason I'm bringing it up is just this. Things have gone straight up for at least the last 5 years. Okay, the U.S. equity market is up 50% in the last few months. But housing stock, housing prices have gone straight up. Now, what happened in that rising tide environment is the A properties, the really quality stuff that deserves value, rises substantially, but it pulls along the B and C, the really not quality stuff, the things that need work and everything else. Now, the hotter a market gets and the more fear of missing out and all of that, prices continue to rise, even if they're things that don't deserve it. Now, I'm mentioning this because as we start to see a turn in the market, we move from a seller's to a bit of a buyer's market, we're going to start to see differentiation in prices between the A properties and those below that. So I would expect to see, I'm just going to use an example, if an A property gets marked down by 7% when things start to turn, you should expect a home that is, I won't even call it a tear down, but let's just say needs a bunch of work, you're looking at down 15 to 20%. And for things that are tear downs or really are over levered or it's got any sort of real hair on them, you could be looking at much bigger discounts. And that's what's not priced in right. So the key is just pay attention, look at pricing, and understand that when the market starts to move, and when I say move, I mean downwards, or there's any kind of stress, there will be significant separation between the best and the worst properties. And expect that to happen more aggressively in the condo market than the single-family home market, and more aggressively in the one-bedroom condos than in the larger condos. Okay, well, we'll pick this up a little bit later, where I really wanted to talk about the Mooch Index and Scaramucci's comments on pricing housing in terms of gold. It's significant. I'm Tom Levine, Native Angelan Real Estate. Thanks for joining to talk about the Mooch Market Index.